Hello and welcome back to the Stocks with Tusky YouTube channel, YouTube's favourite capitalist pig. And today I thought we would have a talk about Heartland Group Holdings. It's up 86% year to date and looking to see if it still warrants a buy. Now, I actually have a long history with this bank. Even before it was one. It was originated as a finance company called Merrick, and as a kid, my grandmother actually put a bit of money in there so that by the time I did turn 18 or whatever, if I wanted to go to university, I would be able to pay for some of that myself, or if I wanted to use it as a deposit on a house. But if anyone in my audience is old enough to remember what happened back then, there was a massive collapse of the finance companies. I believe it was caused by the GFC. I was pretty young at the time, but basically all of these finance companies just started falling like dominoes. Once one went down, basically people started pulling their money out of all of them. They didn't have enough cash to pay out. It was basically like a traditional run on the bank, but these were much smaller institutions. Now, Merrick actually survived that collapse, partly because they were partly owned by PGG Wrightson, which basically lent them enough money to pay out the people and remain liquid. So later on, it merged with CBS Canterbury and the Southern Cross Building Society to form Heartland Bank. Now, many years later, when I did start working, I got a wee bit patriotic about my banks, as young people tend to do. I didn't like the fact that all of my money was being taken by Australian banks and the money was going offshore. So when I wanted a savings account, I went with Heartland Bank, partly out of patriotism. Could have gone with Kiwi Bank, but I sort of wanted to support the little guys. And over all that time since then, I have basically seen this bank growing. When I first signed up with them, they did everything by pen and paper. There was no banking app, and the CEO has actually said part of their strategy for growth has been to digitise everything, and I've seen that happen over the years. They've also become a lot more aggressive with their lending. They currently have the best mortgage rates at the moment. I actually have moved my mortgage over to them from ANZ to get those better rates. And when I first asked them about it 4 years ago, when I bought the house, I was basically told that, they were only doing mortgages in Christchurch, Auckland or Wellington, and that I should go to ANZ because they were a lot stricter on their lending conditions, whereas that has changed a lot recently. They even offered me a credit facility, which ANZ wasn't willing to do, and yeah, their interest rates were way better. I managed to lock mine in at 1.85% on 1 year, which at the time they were aggressively trying to compete with the main banks to try and get more mortgages. So I guess we will have a wee comparison of Heartland Group. I've pulled up them and the other two banks that are on the New Zealand exchange. So now, price to earnings isn't always a good way to compare companies, but with larger established companies, it is fair. So Heartland Group Holdings is 15.91. If we go to ANZ has a cheaper valuation at 12.19, and Westpac here is at 15.54. Worth noting though, if we have a look at the dividend yield, Heartland Bank offers 4.64, ANZ only offers 3.97, and Westpac offers 3.6. Now, Westpac is obviously the worst of the three here, because the other thing to take into account, Heartland Bank being the smaller of the three, has actually been growing, which you can see in the 5-year charts that I've pulled up here. Now, ANZ has been trading sideways for the last 5 years. If you'd bought it during the COVID crash, you would have still gotten a good deal, and ANZ still isn't a bad company or anything like that. But if we look at Westpac has been on a 5-year decline. Certainly not something you want to see. If you're buying these companies, you're buying them dividend growth, which is why I think Heartland Group is definitely the better of the three. Not only are they growing the dividend every year, last year notwithstanding, because they had restrictions put on them by the Reserve Bank, but then so did all the banks. But you're actually going to get some capital appreciation as well, because they are actually growing, and being the smaller bank, they have more room to grow. So if we run through the numbers, now for once I am going to agree with Simply Wall Street on valuation. They put out some wild valuations, but I'm going to agree with them on that. And this too, like, they are growing every year, and they're growing at a much faster clip than the other banks. That unstable dividend track record, as I said, that's not very fair. There was nothing the company could do about that, and they are growing the dividend year over year, which we'll see when we get to that section. It's been on a hell of a tear. I bought it at the right time, fortunately. But yeah, Heartland Bank is sitting at about fair value at the moment. If I didn't have such a large position of this already, I would actually be adding to it, even at these prices, because I do think it could run a bit higher yet. Just basic numbers here. Don't know that I agree with that. But yeah, this is what you want to see. We're trending in the right direction. Growing more than the industry. High level of non-cash earnings. Yeah, that's fair. Good financial health. Being a bank, yeah. Debt to equity, like, banks are always going to have sort of screwy debt to equity. I know that during the COOF, they did actually have a big credit facility that they took on that they didn't know if they were going to need, because everyone was panicking and nobody knew how it was going to turn out, but they didn't wind up utilising that anyway. Excellent dividend yield. Yeah, okay. 4.64, you reckon? Yep, no, that is correct. Sometimes Simply Wall Street and Yahoo Finance have slightly different numbers on it. I was just double checking that there. And yeah. Ooh. Bit of insider trading. That, I imagine that's going to be people who brought in heavily back when the company was at its COVID lows. And you, I really should have looked at this before I started doing the video, huh? Yeah. Where was the dividend? I must have gone past that. Yeah. So the dividend is well covered, as well as the other thing that you want to look at. So they're paying out currently 74% of their income to shareholders. If you see that over 100%, it means that you're probably going to get the dividend cut. And yeah, this is the other thing that it was saying about an unstable dividend track record. I don't agree with that. That was the Reserve Bank restricted how much that they could pay out, and that went for all banks in New Zealand during 2020. So they were forced to cut the dividend. They didn't do that by choice. But anyway, I suppose that's about all we have time for. As I said, if I hadn't already built this into such a large position, I would keep buying it. I started buying this as one of the very first stocks that I bought, purely because I liked the company and I had no idea what I was doing. But I've kept it all the way through the lows, and I plan on keeping it for the dividend. But anyway, that's about all we've got time for, guys. See you!